Good afternoon, this is the Chorus Call conference operator. Welcome, and thank you for joining the ENG Invest Numen Credit Fund update. After the presentation, there will be an opportunity to ask questions. At this time, I would like to turn the conference over to Mr. Stefano Bestetti. Please go ahead, sir.
Good morning to everybody. Welcome. This is Stefano Bestetti. I'm the marketing of ENG Invest. Thank you for joining the conference call. ENG Invest Numen Credit Fund is our long-short credit usage fund. You received a quick presentation just to support the presentation, I hope so. And now I would like to turn the conference over Mr. Filippo Lanza, Chief Investment Officer of Numen Capital and Portfolio Manager of ENG Invest Numen Credit Fund. Please, Filippo, go ahead and then the presentation. Remember the question that you received from our investor, please. Thank you, Filippo.
Good morning, everybody, and thanks for taking the time to listen to our year-end presentation. I would like to point out that we are briefly going through the investment outlook overall for the fund, and at the same time we are specifically digging in a little bit deeper on the financials investment space in consideration of some of the big events that happened both in the Italian banking system and the Greek banking system, and obviously with the expected new legislation coming into effect with the BRRD coming 1st of January 2016, which we think is nothing short of revolutionary in Europe. I will start with our first slide, page number 3, where we go through the core views of the portfolio. We divided in 3 parts: macro, corporates, and financials, which you all know is the way we kind of split the portfolio across. In terms of risk opportunities we see on the macro side, we think overall in Europe, we are living through probably the biggest fixed income bubble we've seen. In Europe, is probably, given the valuation and the levels we see, is one of the biggest we've ever seen in the history of finance. We think we're getting to an inflection point right now. There are 2 opposing drivers for that. One is a good driver. We think growth in Europe and possibly even inflation print may be a little bit better, a little bit more promising going forward in the next few months, and that we think is part of the reasoning behind the disappointing ECB actions or lack thereof in December. So we think that would create some pressure on fixed income because it will make probably additional ECB easing quite constrained. Let's never forget that the ECB aggressive actions have always been predicated on inflation and only on inflation, because their mandate does not allow them to target any other objectives. And let's not forget that obviously the entire fixed income in Europe is effectively a put option on oil, because the main driver for Draghi's action has always been the impact of oil and oil products on inflation and inflation expectations. So having said all of that, and without considering the impact, and even assuming oil is still going to be around this level, stable, if not even on a downward spiral, we still expect data to improve, and so that will put pressure upwards on interest rate in Europe. The other set of drivers, which I think could be quite negative, is the overall political development coming up in Europe. We think 2016 may be very well the year where the Euro construct is going to be probably the most challenged since the financial crisis started. The electoral results in Portugal, Greece, Spain over the weekend, they prove that there is a big disengagement from the initial kind of austerity-driven and fiscal discipline focused policies of the last few years. At the same time, we're seeing an increasingly confrontational and approach and quite a few tensions building up with respect to the immigration and security issues. We've seen that between Italy, Greece, and Germany, and we expect that to go up in terms of pressure. So we see 2 big issues there. We see one, credit deterioration due to the fact that there's going to be less and less political engagement with fiscal discipline and political support for that. and we're going to have more kind of divided governments, which typically is always associated with an expansionary fiscal policy. So that we see a bit of a credit deterioration coming up. Secondly, we have real political tensions coming up because of immigration, because of security. On top of that, a big challenge would be the UK referendum. Could be happen as soon as this summer of 2016. And if UK were to leave, and at the moment the poll seems to be moving to that direction, it would be a major issue for Europe, because the entire architecture of Europe would then be considered more flexible, and with all the possible implications. Where does it leave it right now? Right now we are very negative on the core of Europe. So Germany, France, UK, part is because of their risk-free rate. We think they're very stretched here, and we think growth picture could be a little bit better, so there's a lot of downside there. We don't expect ECB to be much more aggressive than what they've already done. We were of the same opinion after the November decision, but we in a way mitigated our bearishness because of the terrorist attack, which we thought would have justified ECB to be more aggressive, but it was not the case. So on that, we kind of go on with our view that the ECB is truly getting close to the upper end of their ability to be more aggressive. On the opposite spectrum, Greece and Cyprus, two positions we've been very successful on. We've been reducing, taking profit. We think Greece has still got the ability to over-deliver over the next 6 to 8 weeks, but the political volatility associated with that will increase, and that's why we've been cautious, and we reduce the position by almost half of the original, and we are ready to go back in. Greece and Cyprus, we still see some upside, as I said, in terms of valuation. Greece with the biggest, and if they ever go into the right sequence of events with pension reforms, successful review, debt forgiveness or debt reduction, IMF involvement, that could actually trigger a proper QE, which for Greece could move the bonds from the low 60 up to the 80, 90s possibly even. So that's one area where we have a potential up to 50% kind of return on capital over the next 3 months. Having said that, we reduce because political volatility is going on the rise, and we want to be very flexible and opportunistic. Away from that, whether it's Spain, Italy, Portugal, we are becoming increasingly concerned because of the political picture and because of the potential linkages created by the new banking legislation. Away from Europe, on the rest, we remain very opportunistic on emerging markets, and we're particularly focusing on Middle East right now with the oil kind of production, and there's a lot of relative value trade there available between some of the oil producers and some of the oil-consuming kind of countries and companies. Away from that, the other big area of focus for us is corporates. Corporates is probably the place where we see the fastest and most impressive growth in terms of opportunity. Opportunities are very much increasing rapidly day by day, I would say, and that's where we spend an enormous amount of money and time and resources to build on our proprietary research platform. We spent quite some time with some of you over the last few months when we meet. It is a proprietary system, so we don't really publicize it too much, but on a one-on-one basis, we're very happy to walk you through and show you how it's helping us on a daily basis to go more in depth on a single fundamental story and more quickly and gain over those processes like a decent informational advantage over the competition. The one area where we're quite negative is a yield. There is plenty of companies which are merchant banks camouflaged as corporations. Abengoa has been one of those names we've been successfully short. We think there are others that are coming up to fruition, I think, in terms of short. Both for a yield and investment grade, we think there are two main issues, which is point 2 and 3. One is duration risk. There is duration risk of investment grade and a yield specifically is exponential. It's not linear to the risk-free rate. Those markets have enjoyed extremely good returns, not because and portfolio managers a good ability to pick risks or to pick loans, but mainly because they've been overbought by private banks, retail, and everything else as a proxy for bond. Now we look at the picture right now. We think duration is here to possibly create some damage, and and the way the duration risk will be or could be unwound, either because of risk-free rate is going up because of growth, or because risk-free rate is going up because of credit concerns in Europe, we think the impact on investment grade high yield could be more than linear, and within an environment where there is very little risk taking from either investment banks or end investors. The biggest area of opportunity for us remains M&A. We think there's an enormous amount of supply of deals, so those trades very, very cheap. I would say the average return cash on cash is around 10 to 12% on super big deals, super liquid. We, I think, have developed over the years a very across assets kind of approach. So we use both credit and equity as instruments to fine-tune and articulate the M&A trade. We've been quite successful last year. We were from Lafarge, Holcim, Shell, British Gas, SAB Miller, Fiat with the Ferrari IPO, and we've been relatively gradual in building up the position. I think part of the new proprietary system we have is giving us more comfort in terms of going and knowing the details and the specific about the event. So we were spending an enormous amount of time there. With this, we plenty to be done. But away from that, on the corporate side, we're very cautious, and actually we're setting up shorts both on specific names. We think as an overall investment grade is actually a good place to be, possibly compared to financials, which is the main focus of this call. But specifically, again, we have plenty of names where there's going to be M&A activity, names, for example, like Vivendi, the telecom media, or other names in the energy sector, where there's going to be plenty of activity. So it's a good entry point to play both the M&A and the sort of credit deterioration on in terms of balance sheet expansion for some company and some sectors. Away from that, the third area, of course, is financials. We're trying to spend time with this presentation on incredibly complex subject. The new rules of the game have changed completely. We think this is the most revolutionary change in the European architecture since the introduction of the euro. And so we've been spending a lot of time actually with that. We're going to be pleased to announce that we eventually hired our senior analyst on the financial side, and we'll make it his name public in the first weeks of January. As he's transitioning, but he was going to be a terrific addition to the team on one sector, which we think is probably going to be one of the most interesting going forward and one of the most challenging for sure. I'll move quickly to the following pages. Page 4 is where we just going through the main point about the new EU revolution. What do we mean by revolution? We mean the new BRRD, which stands for Bank Recovery and Resolution Directive. This has been something that's been agreed and discussed by the European Council and the European Parliament for the last 2 to 3 years. Basically, what it does do, it enables the national authorities, in coordination with ECB, obviously, to preempt bank crises and, more importantly, to resolve any financial institutions in a very orderly manner in the event of failure. What this was designed for was to bail out the assets of the bank, i.e. preserve the functions of the bank, but at the cost of bailing in any stakeholder on the liability side, starting from equity holders, obviously, but all the way to possibly the depositors. On top of that, which is an incredibly complex and detailed set of rules, we also had the contractual solution that sort of was phased out at the same time, pari passu with the BRRD, which was the issuance of alternative tier 1 securities and CoCos. With those securities, effectively the company, the bank, has managed to issue security. They're quite flexible. So in the case of a failure, they are effectively subject to be transformed or converted into equity securities at the instruction of the board of directors or the shareholders assembly, without having to get a placet from the regulators. The BRRD obviously is going to be applied to AT1 and CoCo security as well, but if you think about failure events or stress event in banks, if you can have moderate stress events that could trigger some of these contractual mechanisms in alternative tier 1, AT1 or CoCos, but they may not be strong enough or big enough to then involve the regulator through an implementation of BRRD. On the other side, if BRRD ever gets implemented, then AT1 and COCO would definitely be subject to it. So I would say AT1 and COCOs are the ones that, because of the new rules, we think is probably the most obviously exposed, and the ones for which we don't think, given the current level of rates and yield, you get compensated for. Moving to page 5, we're trying to basically describe the 3 main pillars of the European Banking Union. The first one, which I think everybody's familiar with now, is Single Supervisory Mechanism, SSM, which is effectively moving all the prudential regulatory power to the ECB. There's a big issue, obviously, of conflict of interest here, because although the two functions are properly segregated at the ECB level, where the ECB is effectively doing 2 things. One is deciding and implementing monetary policy, and most of the implementation of monetary policy in Europe goes through the banking system. But at the same time, ECB is also the regulator of the banking system itself. And we have seen the ECB active in this role for some time. Most of the sort of stress test analysis and results have been managed by the ECB, and we've seen a welcome change in terms of the quality and thoroughness of the analysis. The second piece, the second big pillar, is the Single Resolution Mechanism, which is effectively from 1st January 2016. What is it? It's nothing else than a set of rules which are the same all across the jurisdictions, all across the countries in Europe. What it says is that basically, if there is a failure, if there is a problem, basically the bank needs to be restructured. So you can have a situation where the bank can fail and it needs to be wound up, or it fails and its systematically important operations are split into or transferred into a bridge bank, which then leaves the originating bank, the old bank, becoming the bad bank. So this is the so-called good-bad bank split. Or alternatively, it fails and it needs to be restored via equitization or write-down, with shareholders' creditor bearing the losses. The whole point of the new legislation is any stakeholder on the liability side of a bank now is effectively the holder of a contingent equity piece or a contingent risk capital piece. Because if there are situations which of stress or distress that force the regulator to invoke the BRRD, effectively you can be, the security in your hands can move from being a fixed income security, senior or even a deposit, and being transformed into an equity piece or a much more subordinated piece in the same bank or in a newly constituted bank. The whole idea here was that, and the aim of the legislator was to avoid to have a situation when a bank fail, it threatens the security and the stability, financial stability of the country. The whole idea here is to make sure if a bank goes down, then it's first and foremost its stakeholders on the liability side, is bondholders, is equity holders, is AT1 and COCO's holder to take the loss. At the same time, somebody may ask, okay, but if that loss or if that failure of a bank is too big for the system and it does affect the financial stability of the rest of the system, what is the sort of the next level, the next step? And the next step, I think everybody would need to read a recent interview between the German, one of the wise economists that the finance minister in Germany is using, and they just released an interview with the Italian newspapers in Italy, Corriere della Sera, and this economist, his name is Lars Feld, and he works as a consultant, we understand, for the finance minister in Germany. And basically the whole point there is that if the way that the European policymakers view this is that the BRD will work in case of failure. If the failure are too significant or too problematic or too systemic, then at that point a country may need to ask for help, and they would ask for help from the ESM, which in a way is what Greece has exactly done in the last couple of months. Now, the last piece of which is missing in the banking union is the deposit guarantee scheme, because at the end of the day, the depositors, we all know retail deposits are insured up until 100K, but that insurance is a function of the insurance scheme that each country has on its own. Because at the moment, Europe does not have a Euro-wide insurance scheme. There are a lot of debates, a lot of political tension about how to set it up and who contributes what. So we understand that's very, very important because, and we'll go through the specifics of what happened in Greece and Italy and Portugal, the deposit insurance scheme is the one that at the end of the day makes the insurance of the 100K valuable or not. Because it, of course, as any insurance that you contract, is a function of the quality of or the credit rating of your insurer. To go into the details, and it's page 6, as we call this slide, bailout is dead, but long live the bail-in. What we're trying to make sure that we all aware is, and we keep on thinking about it because it's such a big change, is that what we've seen from 2008 until 2015 is a situation where when banks were in trouble, legally it was very difficult to enforce subordination. Yes, you could have an equity piece or a tier 1 or upper tier 2 or lower tier 2, but the regulator, the only way they could enforce that subordination was by effectively liquidating the bank, which of course was too expensive and it would defeat the purpose. In the new legislation, basically, you don't need to liquidate the bank. The bank basically is going on as a going concern. But what happens is the liability holders, their life changes completely overnight, but the asset holders, they don't really get affected. I'll report a case of Banco Spirito Santo where literally overnight they did, and by surprise, over the weekend actually, they did the good bad bank split. From a customer point of view, nothing really changed as of Monday morning from Friday afternoon, but for bondholders, subordinated bondholders, you lost almost 85-90% of the value of your bond. Now, on page 6, we go through there are three main scenarios, right? The most likely we think is the one in the middle. That's one which is effectively the good and bad bank split. The old bank becomes the bad bank. So there you leave all the subordinated guys and the toxic or problematic or challenging assets. And then you do a bridge bank, which becomes the good bank. And in the bridge banks, you put the good assets, and then you put all the liability holders starting from the more senior, i.e. the depositors, all the way up until you can go. The opposite, the reverse, is true for the bad bank. The bad bank keeps all the subordinated holders all the way up to be able to fund the toxic assets. Whenever those splits happen, most of the times there need to be some sort of recapitalization at the equity level. And that's, so far, what has avoided in Europe to touch the depositor. And we'll go through in the details of what has happened until now, which is going to be very different from what will be likely to happen in the future. On the left-hand side, you see the most extreme, the most draconian scenario, which is what we call the horrible losses, because basically there is a situation where the deficit is so big that instead of doing a good bad bank split, then the regulator decide to effectively write down security. When you write down security, that you don't have much upside later. It's just you have a new security which is worth 5 or 10 or 20% of what it used to be, and so you have you have a lot of difficulty recovering your original value. In the good bad bank split, of course, you can hope that to the extent that the problem is only temporary, is more to do with liquidity than with solvency, then you will be able to recover. The other extreme on the positive side is what we call the best case scenario, but which is very unlikely by design, so to speak, which is, okay, there is a liquidity issue, there's not really a solvency issue, and the bank has got an imbalance between assets and liabilities. There are too many liabilities with fixed income. You know what, we'll just convert them into equity. So you have a situation, an extreme scenario where you convert everything into equity on the liability side as part of the BRRD restructuring. Now, what is interesting there is that theoretically, you can have a situation where before you had a senior bonds, which was like, I don't know, a 20-year bond which was trading at par, and or even lower because of the fixed income price, and then all of a sudden you own a piece of the equity of the bank, and maybe a decent piece of the equity because the valuation of the equity at that time had probably done at relatively stressed levels, then technically you're not capped on the upside. So the equivalent value of your equity claim may actually go even higher than the old fixed income claim. This is more academic, but is relevant to keep in mind because you can have a situation where there can be good banks which are under pressure because maybe there is an issue with perception, or rather than a liquidity issue, rather than a solvency issue, and at that point you may have an equitization which may actually create value in the medium long term, but of course the loss will be very visible at the beginning. Page 7 with the dedicated to the pecking order. Yeah, I think we're all familiar with the absolute priority rule, where in any restructuring the senior guys should not get less than 100 if the subordinated guys get something, i.e. you should always pay 100% of the guy above you before you get something as a subordinated holder. Now, the reality of what we experienced over the last centuries of finance, and it's true in US, it's true in Europe, it's true everywhere, whether it's corporates or banks, is that for like a bunch of different reasons, the absolute priority rule never get respected. So you always have a situation where the senior guys get less than 100%, while the subordinated guys get something. In the case of the corporations, it's because the legislation most of the time kind of gives some power into a restructuring to the subordinated classes, which is the perfect case of Chapter 11 in US. But in the case of the banks, like we've seen in Europe, is because the legislation before was effectively incentivizing bailout rather than bail-in. So you, by accident, you had to give something to the other guys in order to give quite a bit to the senior guys or the depositors. Now, what is totally revolutionary, what we're seeing right now, is that the pecking order is real and is very, very, very defined. I.e., the new legislation will basically bail in 100% of any subordinated before you touch the more senior part. That's very, very important. That is something that is of historical relevance. I.e., for the first time, what you study in the textbook in university is actually going to be real, i.e. the absolute priority rule. But the implication of that cannot be underestimated, because if the market, if the investor, if the depositor really think there is an absolute priority rule in place, then the pricing should be very different, which is, I guess, the main concept behind this call, the main concept for us to revisiting, to change, not to change it, but to update our view on the financials is exactly that there is an absolute priority rule being implemented in Europe, and by the look of it, the enforcement of that will be pretty automatic. It will be very difficult to derogate, to move away from that. Now, the other big aspect that we're trying to emphasize is when we country credit risk is coming back through this, because the insurance is only as good as the insurer. That's very important. I mean, one of the main reasons why this legislation was started in the first place was to kind of sever the kind of link between the country and the banking system. Now, that sort of is being kicked out of the door, but it's coming back through the window, like they used to say in Italy. Because at the end of the day, you as a depositor, you need to rely on your national insurance scheme, because there isn't such a thing as a European one, not for now. And it doesn't seem to be happening in the foreseeable future. Page 8, we're trying to go through some of the current restructure we've seen. I think you read it in the media, you read it with a lot of analysts, and then we are amazed actually by how little coverage this topic is taking. But a lot of people look at what happened in Italy or Greece or Banco Spirito Santo, and they think, wow, that was pretty tough. The reality is all these restructurings are hybrid combination of the different parameters available with the BRRD. But the actual combination implementation of those parameters is actually being relatively biased and generous to a stakeholder class rather than another. But overall, has been more generous than what the new rules would have dictated to do. The reasons why is several, but for example, in the case of the Italian banks, the insurance scheme fund was recapitalized or refunded by the big banks, and with that money, they decided to invest into those banks, into the restructured banks, in order to avoid losses for the senior and the depositors. So this was quite generous for the senior and the depositors, and it was generous at the cost of the big banks putting money in, which then raised another issue of how much is this issue a issue of small banks, of undercapitalized or underfunded bank, how much is really an issue for the entire banking system, because the linkage come back through the insurance, but it also come back through the other banks, because banks need to contribute more money going forward in the insurance scheme post the restructuring of a bank. In the case of Greece, actually, it was done in a different way. Basically, the policymakers after the August deal decided that Greece would have been granted an underwriting, a line of underwriting commitment from the SM of almost 20 billion euro in order to recapitalize the banks. Then eventually with that, they managed to approach the market, and they pretty much managed to do like a private solution, but always with the idea of protecting the depositor. So in this case, they decided explicitly not to touch the depositors, which with the new rules would have probably been affected. And then thirdly, we had the situation of Banco Espirito Santo in 2014, which was even more different, because in that case, it seems as a desire of protecting the depositor of Banco Espirito Santo that decided to invest in the holding companies. And so basically, in order for that to happen, they decided to effectively burn even more the subordinated bondholders in order to create value to protect some of the investors, which again is something that would not have been allowed to happen in the new set of rules. So, and just to give you a quick graphical sense, if you look at page 9, you have what happened to the subordinated and senior bonds in the case of Banco Espirito Santo. Before August 14, as you can see, the yellow, the amber kind of line is the subordinated paper. As you can see, those bonds were trading well above par, while the senior was trading below. And part of the reason is because the subordinated had a higher coupon, which is the case for most of the AT1 and COCO bonds. And so because of the rates where we are, it was trading well above par. Most of the COCOs, most of the AT1, they're all trading well above par. Once the regulator decided with an unexpected overnight kind of resolution, which again is a very hybrid resolution, a very biased resolution, which would have never been allowed to happen now, because national input is impossible now. You can't change the rules. But after that resolution, you had a situation where that subordinated paper was trading well above par, started collapsing and went all the way down to 20, and then from there is now trading in the low single digits. While on the other side, the senior being left into the kind of the good bank, which surprisingly enough was called Novo Banco, which means new bank, stayed around pretty much par. Page 10, I'm trying to give you the sense why we're so focused on financials. The reason why we're so focused on financials is because financials are huge. They are immense. We're talking about 30 to 35 trillion euro liabilities in Europe, which means that once you make all your assumptions, what is the average deposit retail and what is the insurance for those, then you get a sense of how much of that, which historically has been fixed income, is actually sort of a contingent short put option on equity. And so we think if that repriced, there could have meaningful impact on the market. Now, the hit we get on the banks may be coming from somewhere different. It may be coming from oil, it may be coming from high yield, it may be coming from all sort of things. It could be, again, a tax issue. It could be a RAF trade. It could be anything. It doesn't really matter where it comes from. But when something happens, there will be two parallel processes. One is what happens at each 81 COCOs and what the board of directors has to do in its fiduciary duty about that, if there's a situation of stress. And then if the stress becomes more like a distress, then at that point the regulator has to intervene, and once it starts, it's sort of a relatively mechanical kind of procedural approach. Page 11, we went down specifically on the 81. The 81 right now, we're talking about a total of almost 100 billion. There's going to be plenty more supply, not just in terms of 81 and COCOs, which are required by the regulators, but also in terms of the other security like TLAC and other loss-absorbing securities. So in terms of demand and supply, financial is not only huge now, but it'll probably be bigger later, and we think that the repricing hasn't really started yet. And page 12, we're trying to go through what is a bank run now, how does it look? The bank runs will look very different going forward because of the new legislation, especially in a world where we live in sort of instantaneous kind of news flow, social media driven environment. The way it changes now is that the retail investor is becoming the new kind of vigilante here, because they need to make sure that they are safe. And at the first hint of an issue, whether it's true or not, whether it's fueled by social media, whether it's fueled by real events, they may move relatively quickly. And again, we live in an online environment. You don't need to queue from the bank. You can just place the orders. And we noticed with our experience in Cyprus and our experience in Greece, there is quite a lot of activity that happens online. And that, again, that accelerate the speed at which the banking run becomes self-fulfilling. The other big issue we have here is the consensus trade. I think, like us, like many other portfolio managers, banks was a very easy way to make money by being long over the last few years. Last year, as you know, we lost money being short because we're very bearish on names like Hypo Alpe Adria or Deutsche Bank, and then we had the short initially because we thought the new rules would have happened, and then eventually we gave up thinking they're going to be bailing them out again, like they did initially with Hypo Alpe, only then to find out with BES eventually they did what they said they wouldn't have done. But to get a sense, the most consensual trade that we see in terms of market value and in terms of conviction from the investment community, whether it's investment banks, whether other managers, or so on, we think is really into the banks, and especially 81 Cocos, which was probably the only yielding security group for some time. But we think that being exposed to both rates and the new legislation, we think is something that we don't want to be in. So we cut pretty much all the position, and we actually will go through how we intend to approach it. Yeah. The second item that I was trying to point out is that people look at banks as idiosyncratic, and that was the right approach for the last few years. Idiosyncratic on their own, and then on top of that, within their own national jurisdiction. Because the new rules, the new legislation, the linkage they are creating across the bank and the other banks in the sector, the bank and the other banks in Europe is pretty instantaneous and is pretty strong. Which then gives page 13. How do we position? How do we look at that? We need to look at banks very different from what they used to be before. These new rules are very important, and to get a sense of how important they are, you just need to look at the experience of Greece and Italy, where literally both governments did everything they could to accelerate the restructuring in the last 3 months to avoid to be subject to the new rules comes Jan 16. And so they had to go through restructuring and everything else where with a speed which, for example, if you look at Greece, the speed at which they restructure the banks is 10 times faster than the speed at which they approach the structural reforms like in pension. And similarly, in the case of Italy, of course, there was a big focus trying to get this thing done before January 16, and not just from the government, but also from the other banks. So our first point is we think financial risk is not being repriced for the new legislation. We think there's a very high level of complacency there. So we think from an index point of view, in terms of repricing side, we think we've seen an enormous amount of outperformance of financials over corporates over the last few years. We think that's arrived, kind of is exhausting itself now, and I think we want to go the other way around. So we want to start having as a aggregate basis, we want to be short both financial senior and financial sub versus investment grade, and versus even some of the high yield quality names, but overall short. There's going to be plenty of relative value to be done across different banks, again, because the legislation is creating linkages. The legislation, you can look at it as in is bringing the correlation across different banking securities and different banking systems much higher than what it used to be before. So there's going to be plenty of relative value trades, either through CDS, cash bonds, or other security, and there's going to be plenty to be done also on capital structure. You heard us in terms of 81 COCOs versus other part of the capital structure. We think the spread between different subordinate portion of the capital versus more senior, that spread could explode over 2016. The positive side on the banking side is, of course, because the new legislation, we think there's going to be an enormous amount of pressure coming from either the regulator or the banking equity holders themselves to push for consolidation. The good side also that because of the new legislation, there was a big deadline, deadline that pushed a lot of restrictions before. So we don't think we're going to see any restriction in the immediate future. Of course, excluding black swans like tax penalty, like we've seen with BNP ages ago, or like a rough trader, like we've seen with SocGen, or some other issues in terms of accounting, like with Hypo Alpe or with HHSGen. But we do expect quite a bit more M&A and consolidation. And so at the margin, actually, a lot of people look at the new legislation as it is very biased towards the small banks. We actually think that it's quite the opposite, because big banks are the ones that got the most to lose, and we've seen it both in Portugal and in Italy and in Greece. They were very keen to kind of participate to avoid additional losses there. So overall, I would say, first of all, there's going to be a lot more volatility in financials. Secondly, we want to have an overlay bearish approach and short bias especially because the new credit for swap contracts are much more protective, and so there's going to be a very good place to be. We're very wary of duration embedded in the financials, but at the same time, we think there's going to be plenty of M&A opportunity, where probably going to be some good long opportunity. And away from the direction, there's going to be plenty in terms of relative value and capital structure to play around. And the kind of analysis we're going to be doing is partially is going to be very supported and helped by the new software system we got and the new senior analysts we hired, because we think there's going to be plenty of there's plenty of information and knowledge that still needs to be absorbed and priced by the market as we go, and partially and not exclusively because these new changes are happening across the end of the year, and some of the restructuring have been done before in a very hybrid context, which will be very different from what we will see going forward. So with this, I would conclude my intervention and leave it open to any sort of questions from any investors out there. Thank you.
Excuse me, this is the Chorus Call conference operator. We will now begin the question and answer session. Mr. Lanza, there are no questions registered at this time.
Okay, Filippo,
then
we can conclude.
Thank everybody. Have a great Christmas, and if there's any issue, other things that can come up to you, then I'm very happy to address them in directly or via Stefano or with us, Nico, and any sort of meetings that you guys may want to have in the new year. Have a great Christmas and Happy New Year to everybody.
Hey, thank you, Filippo. Thank you so much. Merry Christmas to everybody.
Thank you. Thanks. Bye-bye.